Hi, my name is Van Hesser. I'm a Senior Managing Director here at KBRA. With me is Ethan Heisler, Senior Director at KBRA, and this is Bank Talk.
Hi, Van.
Hi, Ethan. Are we really going to call this Bank Talk?
Bank Talk it is.
Bank Talk it is. All right, so what does that mean? Each month, we will talk about some of the leading issues that are relevant to you as investors or issuers or bank treasurers in the bank space. We'll come at it from different perspectives. I run the corporate group here at KBRA and will represent the bond investors' viewpoint. Ethan is the editor, as many of you know, of the Bank Treasury newsletter, which he relaunched this past month at KBRA, and he will represent the issuer's perspective. So Ethan, last month, in our inaugural KBRA Bank Treasury newsletter, you talked about LIBOR and CECL. What are some of the things you're thinking about for this month?
Well, Van, I think that the number one issue is this new bank bill, S1555, the Senate Crapo Act, that's going to be voted on in the House next week and most likely headed for a signing ceremony in the Oval Office. It's pretty big news. We haven't had a bank bill, a bank legislation in 8 years since Dodd-Frank.
Well, so as we think about things from a credit investor standpoint, bank regulation is an enormously important element in our valuation equation. So what are some of the things in there that we should pay attention to?
Well, there's a couple of key points in this bank bill. Number one, and probably most importantly for the largest institutions, it raises the SIFI threshold from 50 billion to 250 billion. That's number one. Number two, it loosens up mortgage origination. If you're a bank that's under $10 billion in assets and you're going to hold your production, you're not going to need to worry about all the paperwork related to the qualified mortgages and so forth. You can just simply hold those mortgages. So that's going to ease up. A third point is that it creates a regulatory off-ramp so that if you're a bank that's under $10 billion in total assets and you have a tangible equity ratio over 10%, you are going to be deemed compliant with all regulatory capital rules, and regulators cannot require you as a result of that to restrict your dividends in any way, shape, or form. So it's a simple ratio. I guess the one that's probably the least valuable, but definitely is one of the key points that they made, is that banks that follow the LCR should be allowed to include high-grade municipal bonds, or high-grade municipal bonds will be eligible for inclusion within the LCR.
Okay, so within that sort of hodgepodge of parts of this bill, a couple of things have resonated with me, and I think that are going to be important for investors. A lot of this, of course, just makes bankers' life easier, right? Whether it's raising the SIFI threshold, the degree to which institutions have had to spend money on becoming compliant with this increasingly complex regulatory framework is well known. So rationalizing some of those rules, I think, is going to resonate with our bankers out there as a positive development. Certainly things like making it easier for smaller banks to get back into the mortgage business, I think, will also be helpful. Community banks.
Can we stop on that?
Sure.
Here's my question for everybody. I still don't understand it. There isn't enough demand. If you look at the total amount of mortgage loans, I was just looking at this yesterday. The total amount of resi mortgage loans in the system actually has not grown.
Right.
It's been $10 trillion for the last 10 years, basically. You look at the same. And small banks actually, during this entire time, you look at the Fed series, small banks actually increased their share of resi.
That says something about some of the large banks and how they are backpedaling in this space. I agree with you. I think the question isn't that there's not enough credit available. It's maybe that there are not enough people out there looking to commit that kind of money post the financial crisis and the collapse of the real estate market 10 years ago back into residential mortgages. So I think that's part of it. However, what I would say, there are a number of community banks that we talk to. Obviously, we cover quite a few of them. And they will be happy to add an easier mortgage product to their loan mix. Is it going to be a game changer for them? No, but it allows them to get back into a business line that traditionally community banks have played a very important role in.
Yeah, I think that the biggest concern I hear among banks is how do you generate earnings? And I think that the key part of that is where's the real demand for credit? It just doesn't seem, if you look at the senior lending officer survey that just came out, there's no evidence that lending demand has spurted up or grown in any way, shape, or form since the beginning of the year. It's just really fallen off a cliff.
You're right. Let me make one last point, because I know a lot of analysts out there are going to be going through the details of this bill and trying to figure out what's going on with capital ratios. And since there's such a focus in the fixed income community on capital ratios, I want to make a quick point here. And that is that from our perspective, right, banking is a regulated industry. All the capital and reserves in the world are not going to save you if you don't have a competitive business model and if you can't manage your risks. I think some of this simplification of the capital ratio requirements might have a modest give back, and I would emphasize modest, which I don't think will be all that material to investors. We really don't care here at KBRA whether somebody is levered at 10 times or 11 times. You're highly leveraged in either case. And again, it goes back to, do you have a durable business model that produces sufficient growth at a sufficient margin without having to reach? That's what's the most important thing from a credit perspective. That's the thing that we think about. So it's a way of saying, don't look at some of the advance stories out on this bill and worry about how the changes in capital ratios are going to affect the credit worthiness of the banks that you invest in. It's not going to be that material.
Yeah, but Dan, do you see banks, if I gave financial institutions that we rate, if I gave them the opportunity, said, regulators are okay with you taking more leverage, do you see appetite to take more leverage by banks?
I honestly really don't. And here's the reason why. I think, the various capital requirements that we've had, and it's certainly been evolving over the last 30 years, just force banks to make the kinds of resource allocation decisions that they're supposed to make anyway. If you told me that the banking system could not make an acceptable return because they were having to carry too much capital, then I would say yes, from a policy standpoint, capital regulations should be relaxed, i.e. banks should be able to lever more so that it provides the essential fuel to the economy. I think what we have, again, bankers will complain that they still struggle in some instances to make an acceptable return. By the way, tax reform has gotten a lot of, basically the banking industry now up over that 15% return on equity. That is plenty sufficient. I don't think taxpayers want leverage to increase it at the banks. I don't think policymakers do. And honestly, I don't think bankers are really out there hoping that they can lever more. This formula kind of works.
Yeah, well, I think that these challenges, you mentioned the 15%. I'm not so sure that 15% is the actual required rate of return with the tax rate lower. So I'm not so sure that that's actually now the yardstick, 15%, I think, for some of the issues, certainly for equity investors. I think one of the numbers that came out today in the news, and I know we have another minute, but another news item was how the 3-month T-bill rate, the yield on that, actually crossed the yield or the dividend yield on the S&P 500 this past year. So think about what that means in terms of flattening of a yield curve and opportunities to generate income. And you can go out to the riskiest type asset and your returns are still pretty low. I mean, you're encouraged to sit in cash. That's key. I think the other question for banks that I speak to is, what happens when this 10-year is material? We come back in the fall, and the 10-year is over 3%. Does that put us into about where banks start taking more risk? They take more duration risk? They finally think, I don't know. That's what I'm waiting to see.
Well, I think those are things that we will watch closely. I think we've got some time to watch this all play out, and that may be a discussion for our next version of Bank Talk.
Right, Dan. I think we've run out of time. Thank you very much. And it's great, everybody, for joining us.
Thank you.